Hey value investors, thank you for joining me. My name is Michael from Deep Value Returns on Seeking Alpha. Today I want to talk about Chewy. So Chewy is kind of a mixed bag. I think that investors is probably too pessimistic the stock right now. So we're going to talk about its revenue growth rates fizzling out. We're going to talk about its free cash flow capabilities. Then we're going to bring this all together and talk about its valuation. So let's just jump right in. So this is the graph, right? So Chewy was a COVID winner, and in 2020 its stock went up really strongly, like a lot of the other players that we're going to come to right now. And then this is the guidance for the remainder of the year. So we're halfway through 2021 and the guidance isn't that strong. We're looking at approximately the mid-20s. So investors are coming to terms like, is the company really going to be growing? Is it a leader in its space? Is it growing significantly fast enough to justify a higher multiple? Or is it the case that the stock is kind of fizzling out already and it was a pop and fizzle? So let's think about this a bit further, right? In this graph here, I've shown a few companies, right? So the companies are not really peers to Chewy. I just put them to demonstrate that all these stocks, we're talking about Fiverr, Pinterest, Zoom, Peloton, all in the last 3 months are down, okay? So it's quite interesting because if you look at the backdrop, if you look at the S&P making all-time highs, you know, there's this kind of hangover in the post-COVID trade that investors are kind of like just indiscriminately just kind of unwinding that trade. And I believe that when investors are willing to put in a tiny bit more work and think through, okay, what's the underlying prospect right here for this company? Does the valuation make sense? I think that there's some return to be made. So let's continue digging forward, okay? So we can see here, there was a lot of noise in the quarter in terms of in the earnings call, how they talked about customer addition and what's going to and the attrition rates going in this year and how that compares to last year. So I think that they didn't really do themselves a lot of justice talking about that too much. They probably but I suppose it would have come up anyway, but because they put it out there so much in analyst face, if the analyst wasn't really going to go forward and be asking about these kind of questions, you know, it would have probably surfaced at some point on some Twitter trade or something, on some Twitter tweet. So they had to talk about it. But anyway, this is the thing that I wanted to talk about. We can see that right now, for this, it was going to be always going to be a difficult quarter, Q2 21, and you can see that the number of customers was up 21% year over year, okay? So the number of customers coming up is strong. Now, this is always going to be, in my opinion, what's a strong business model. A strong business model is where customers are coming in more and more at increasing rates. I wouldn't be so attuned to look at pricing power right now. I would be more focused on getting the customers in through the door, getting the customers familiar with using Chewy, getting that habit formation going. That being said, the active net sales per active customers was up 14%. Now, this is the highest in the company's history, so it's not really doing that badly either there in terms of being able to upsell to existing customers. But the thing that everyone got caught up was on the adjusted EBITDA line. So you can see here, adjusted EBITDA line, this is for last quarter, Q1, okay? So we can see that for Q1, there's a strong step up in adjusted EBITDA. So it came in at 770 million. So investors are like, okay, you know, yeah, growth rates are starting to fizzle out, but the profitability is coming up. That's what I was thinking as well before the earnings all came out. And then you can see right here that how it fared in Q2. So you can see that from 77 million, there's actually a sequential decline. And investors are like, okay, you know, what's going on here? Is the company really trying to carve out increasing profitability? Because that doesn't seem to tally up, right? And management said on the call, yeah, we are continuing to improve that, and we are going to be improving the adjusted EBITDA line this year by approximately 120 basis points compared to last year. So I've done some kind of calculations here. So we can say that, for example, for this year, they're going to make approximately 220 million, and they made so far 100 million in H1. That means H2 is going to make approximately 120 million. That means that for the year, we're looking at 220. And you can see here that for the first half, the EBITDA was approximately 100 million and the free cash flow was 120 million. So there's a strong free cash flow conversion from EBITDA. So the company, yeah, it has problems with its growing its revenue. Yes, it has problems that its adjusted EBITDA margins are not very strong, but it's converting that EBITDA quite strongly into free cash flow. So it's a mixed bag right here. So again, this is the whole thing, right? So right now the stock is priced at 3 times next year's sales. And if you look at it, yeah, I mean, it's kind of like, it's not that cheap, particularly when you talk about that EBITDA line is not being the EBITDA margin is not very strong. On the other hand, you have to think about the company is converting quite rapidly to free cash flow. So yeah, you are kind of starting seeing that growth will kind of mature a little bit, but then you also see in the free cash flow conversion. On the other hand, I wanted to just point out, so this is a company that I do own, is Bark, and Bark's business model isn't directly a comparison with Chewy, because Bark is much more about selling toys. This is high margin business, but it's lower frequency. So you kind of, that's a put and take, but you think about Bark is growing meaningfully faster. So even if we're going to be conservative about it, next year Bark is probably going to grow at 35% CAGR. So it's growing faster than Chewy. It's priced at 2 times next year's sales. Gross margins are higher. On the other hand, Bark is nowhere near generating free cash flow. It's going to be some time still. Maybe we're going to be inching out into 2024 before Bark is making free cash flow. But Bark is significantly cheaper than Chewy. But the whole space here right now, you're not paying a large multiple to be involved in this space. So I think that investors are probably quite gloomy here, unnecessarily so. If you compare with other COVID winners, these two plays are really, really cheap. So in any case, if you want to find out what kind of stocks I'm interested in, don't forget to check out our marketplace. It's called Deep Value Returns. I'll tell you the stocks I own, and I'll tell you some stuff to look out for, and you're welcome to do a totally free trial to see if it suits you. And you can come in, check it out, and if you like it, you stick around. You can unsubscribe anytime before the 14 days, and you're not going to be charged anything at all. And we have a growing investment community, and as I say to everyone, I'm not really a place to outdo you. I'm not really a place to replace you in what you do. I'm just a place that offers you 1 or 2 investment ideas a month, and you come in and check it out, and if you like it, you stick around, and if you like, you take the ideas and you add them to your own portfolio, and you know that someone's on the back end doing all the due diligence for you, because sometimes you haven't got the time, or you're kind of new to investing, etc., etc., and you're welcome to check out all the reviews on my marketplace, and you'll see that